Thank you. Good morning and welcome to our Market Insight webinar. Today we'll be covering the topic of integrated risk management and specifically we'll look at the latest guidance issued in December of last year by the Pensions Regulator. I'm Paul Darlow and I'll be chairing today's session. I'm joined by Victoria Reynolds, an actuary in our London team. Victoria recently spent 12 months on secondment to the Pensions Regulator in their funding and risk team, and so she's ideally placed to guide us through this subject today. And I'm delighted that we're also joined by Alex Hutton-Mills. Alex is Managing Director of Lincoln Pensions, which has grown over recent years into the UK's leading independent covenant provider. And given the pivotal nature of covenant to today's topic, it's particularly helpful to have Alex with us today. So to provide context for why the Pensions Regulator is focusing so heavily on this subject, we'll start by looking at what happened to the funding position of pension schemes over 2015. We'll then consider why risk management is important in the face of the volatility, uncertainty and risk that pension schemes face. And we'll then come on to discuss integrated risk management itself, what it is, and how pension schemes might go about applying it. Now, in order to help people gauge how other schemes view this subject, we'll be running some live polls throughout the webinar. These polls are anonymous and the results will be shared with you during today's webinar. So please do take part in these polls as the main purpose of them is to provide you all with a snapshot of where the market may be heading. And we've also allowed time, hopefully, for a few questions at the end of today's session. So please do submit them as we go through the event. And you can do this by typing your question in the box shown on your screen. We'll post a Q&A document on our website shortly after the webinar, covering any questions that we do not get time to answer today. So we'll start with Victoria looking at how pension scheme finances evolved over 2015.
Thank you, Paul. 2015 was a year of turbulence for the financial markets and therefore turbulence in the funding position of most UK pension schemes. According to the Pension Protection Fund, the total deficit in UK pension schemes varied from a high of over 350 billion to a low of around 200 billion over the year. That equates to funding levels varying between around 78% at the worst state to nearly 85% at the best state, so a 7% swing in funding levels over 2015. However, this combined funding position rather understates the volatility experienced by individual pension schemes. Now, the graphic on this slide shows the movement in the funding position of a fairly typical pension scheme over 2015. Now, the numbers shown here are accurate because they come from our online daily valuation system called Model Solutions. The pension scheme has liabilities of around 100 million and a fairly typical investment strategy. And what you can see is that this particular scheme was indeed in deficit the entire year. However, the size of that deficit varied significantly, from a low of around 15 million to a high of 27 million. In other words, this scheme experienced a difference of 12% in its funding position over the year. And so what does this mean? And perhaps more importantly, why is it a problem? Well, if the pension scheme had set its funding strategy at the best state in the year, it might have required cash contributions from its sponsoring employer of £1 million a year, and that would be to close the deficit over 10 years. Or, considering this over a shorter period, £2 million a year to close the deficit over 5 years. In contrast, had the funding strategy been set at the worst state, the cash contributions required to fund the deficit would be around £2 million a year over 10 years, or £4 million a year over 5 years. In other words, the cash contributions required to close the deficit at the worst state are double those required at the best state. Looking at this another way, if the additional deficit caused by adverse market conditions at the worst state was to be funded entirely by additional investment performance rather than cash contributions, the scheme would need to achieve additional investment growth of 3% a year on all of its assets in order to close the deficit over a 5-year period. I'll now hand over to Alex to discuss why risk management is important in this context.
Thanks, Victoria. So, I mean, just putting that in context, if you were sponsored by a company in the oil services sector, and you had that 12 million difference between your worst state and best state deficit, and the context for this was that given all the news that's happened recently about the change in oil prices that have for a prior period been relatively stable at between $80 and $100 a barrel, and have now dropped to around $30 a barrel. The question is how important risk management and pensions risk management would have been to you. If you hadn't undertaken any pensions risk and integrated risk management, then in a sense you're arguably less able to potentially understand and cope with and have contingencies in place for the events that have happened. So the question then is when risk management turns into crisis management. So one of the important aspects of risk management is not to say don't take risk, but it's to say understand and have thought about the sorts of scenarios that may occur, which may have included in this particular example the likelihood of a sustained low oil price or even oil price shocks. So I touched on risk management potentially becoming crisis management, and there's an extract from a publication essentially that I think captures why it's important to risk manage rather than crisis management. So essentially, over the long term, as it says, the only alternative to risk management is crisis management. And crisis management is much more expensive, time-consuming, and embarrassing. I suppose the only thing I'd add to that is that crisis management isn't always necessarily successful. So again, it's better the devil you know, and it's better to have thought about things in advance, albeit it's not entirely possible to have covered all the scenarios before those particular events happen.
So, having considered the importance of risk management for pension schemes, we'll now come on to look at integrated risk management. So what is integrated risk management? Well, firstly consider this generally before moving on to see how it can be related to pensions. So integrated risk management provides a framework or a structure for management across a business or organisation, and it typically involves a number of steps, such as identifying particular events or circumstances, be they risks or opportunities, that could impact on the organisation's objectives, assessing them in terms of their likelihood and the magnitude of their impact, understanding what that means for the likelihood of the organisation meeting its objectives, determining a strategy for dealing with the risks and opportunities identified, and then, of course, monitoring progress over time, appreciating that the risks do not remain static. Now, the main theory of all of this is that by identifying and proactively addressing risks and opportunities, organisations can protect and indeed create value for their stakeholders. And I think this last point is vital and worth repeating. Integrated risk management is not about removing risk. It's about making sure that the amount of risk that is being taken is understood and enabling management to take risk and indeed pursue those opportunities in the right areas to add maximum value. And I think it's important to note that integrated risk management isn't something that the Pensions Regulator has just dreamed up for pension schemes. The basic concept has been applied in several industries for well over a decade, and in particular the financial services sector. The changing regulatory environment, economic turmoil and growing complexity has helped to make integrated risk management a key focus for financial institutions. Now, perhaps nowhere is integrated risk management more important than in those banks that are deemed to be too big to fail. Indeed, those banks are a good case study as to the importance of managing risk in an integrated way. So looking at the 2008 financial crisis, this was marked by the contagion effect within interdependent markets and players. So those simple risk diversification strategies often did little to mitigate losses, and indeed certain products, such as derivatives like credit default swaps, relied on such a complex and interrelated web of counterparties that all parties suffered when conditions changed for underlying products. Now, our report into the 2008 financial crisis found, and I quote, that those firms that demonstrated a comprehensive approach to viewing firm-wide exposures and risk, sharing quantitative and qualitative information more effectively across the firm, and engaging in more effective dialogue across the management team tended to deal more successfully with the ongoing market turmoil. So that's integrated risk management in a generic sense. Integrated risk management for pension schemes is no different. It requires pension schemes to identify and understand all material risks, firstly in isolation of each other, but then in aggregate. The amount of risk being taken should then be compared against the capacity and appetite of the scheme and its employer to cope with those risks should they materialise. And this can then be used to inform the pension scheme strategy in areas such as funding and investment. So we will consider this in a little bit more detail later. However, from a high level, in pension schemes there are three typical sources of risk: covenant, funding and investment, all of which are interrelated. Now, since the regulator issued its Code of Practice on funding back in 2014, most pension schemes have started to consider these risks and interdependencies to some extent when they set their valuation assumptions and funding strategy at the time of valuation. However, a pension scheme cannot say that it's applying an integrated approach to risk management if all it does is consider risks every 3 years at the time of the valuation. If it's actually going to add value, integrated risk management needs to go much further than that, and certainly beyond setting discount rates in the valuation assumptions. And so anyone who has been in dialogue with the regulator over the past few years regarding their valuation will recognise that the days of needing to meet the regulator's triggers for assumptions are long gone. The focus now being on the wider aspects of the pension scheme's approach to risk management. So, what does integrated risk management allow trustees and companies to achieve? Well, in essence, applying an integrated approach will enable trustees and companies to answer the following questions. What risks might prevent the scheme from meeting its objectives? And indeed, what risks might prevent the company from meeting its objectives? Remembering, of course, that it's very much in the company's interest that the scheme is managed properly to avoid risking its sustainability. How likely are these risks to materialise? What is the impact of these risks if they occur? So perhaps this might lead trustees to place less focus on risks which are less likely to occur in favour of concentrating on those more likely. But this, of course, needs to be considered in the context of how material a risk is. A risk with a small likelihood but a material financial impact may remain a material risk. What are the relationships between these risks? What is the risk appetite of trustees and the employer? And are the trustees and employer comfortable with the risks being run? If risks are greater than the risk appetite, should the overall strategy be changed? And even can the strategy be changed? Are there any viable and indeed affordable alternatives that don't negatively impact on the sustainable growth of the employer when removing risk might mean agreeing to a higher contribution? What alternatives to funding are there which would allow trustees to become comfortable with accepting risk beyond their risk appetite? For example, parental guarantees, contingent assets, or perhaps profit-sharing agreements. What capacity is there to put the scheme funding or the employer's financial position back on track should these risks materialise? Now, a good example here is to consider investment risk. If a scheme strategically invests in what may be deemed riskier assets to achieve returns to fund its deficit, and the returns are lower than expected, can the employer afford to increase contributions and over what time period? Is there sufficient support available to allow the trustees and employer to be comfortable with the investment risk being run? And again, this leads back to the question, should the overall strategy be changed? Maybe, but there may also be sufficient support to underwrite the risks. And lastly, what monitoring should be put in place and what actions should be taken if risks materialise?
Okay, so that leads us on to the first of our live polls for today. And the question is shown on the screen. And you will shortly be able to enter your answer to this question in a box that will appear on the right-hand side of your screen. And the question is, do you think there is value to pension schemes in answering these questions? And we've suggested 4 possible responses. No, there is no value in pension schemes answering these questions. Possibly, yes, or not decided. If you could please choose one answer from the box that should have appeared on your screen and select the appropriate entry in that box. And say all responses are treated anonymously, and we will share a summary of the results later on in this session. I'll just give a little bit of time for people to complete that poll, which is now opened. And so we'll allow about 45 seconds for you to answer this poll. So again, just repeating the question, do you think there is value in pension schemes answering the questions? Possible answers are no, possibly, yes, and not decided. 25 seconds have elapsed, so we'll give 20 more seconds for people just to pick their answers. Okay, 10 seconds left. The question again, do you think there is value in pension schemes answering the questions? Once we've compiled the results of this poll, we will share them with you later on in the session. Okay, so that's the first of our live polls, and now we will move over to the second of our live polls, because that poll should shortly be closing. And the second of our live polls works in exactly the same way as the first of our live polls, and the question for this second poll is, if you are involved in a defined benefit pension scheme, has your pension scheme already put in place an IRM strategy as outlined previously? And again, I've suggested 4 possible answers for this poll, and the possible answers are no, yes, it's currently underway, and not sure. This second poll will be opening shortly, and you should be able to see it on the right-hand side of your screen very soon. So just bear with us a second whilst we open this poll. Okay, that poll is now open, and again we'll give you 45 seconds to select your answer. So again, if you are involved in a defined benefit pension scheme, the question is, has your pension scheme already put in place an IRM strategy? And the possible answers are no, yes, it's currently underway, and not sure. We'll give you 20 more seconds just to complete your answers to that poll. Okay, 10 more seconds, and then we will close the poll and move on to discuss integrated risk management in practice whilst I collate the answers to the polls. And as I say, the answers will be treated anonymously, and I'll share those answers with you later. So we've now closed that poll, and as I say, whilst I analyse the results of the poll, what I will do is hand back to Victoria to discuss how integrated risk management works in practice.
Thanks, Paul. So I'm sure some of you are wondering right now, okay, where do we start? But perhaps a simpler question to tackle is, when do we start? So because integrated risk management is much broader than just setting valuation assumptions, the Pensions Regulator has said that schemes should consider implementing IRM now, whether or not they are currently working on the latest valuation. If the example at the beginning of the webinar demonstrated anything, it was that the fortunes of a scheme, and indeed its employer, can change quite dramatically in a short space of time. The risks facing schemes, and in particular those relating to covenants and investment, do not follow a 3-year valuation cycle, and indeed are ongoing. Now, the regulator recognises that one-off costs will be incurred to implement an IRM strategy for the first time, but does recognise that the time and effort spent should be proportionate. Interestingly, though, the regulator doesn't say that the time and effort should be proportionate to the size of the pension scheme. Instead, that the approach should be proportionate to the likelihood of the objectives of the trustees and company being threatened by the risks. And now, in my experience, the risks being run by smaller pension schemes are often proportionately that much more significant than those being run by larger arrangements. And so there isn't necessarily a correlation between the size of the scheme and the time that should be spent on implementing risk management. And really, to put this into context, If the deficit of a small pension scheme were, say, to increase at its next valuation, even if this remains a small deficit in the grand scheme of all UK pension schemes, the increased call on cash contributions could be significant relative to company cash flows. And under this scenario, the long-term sustainability of both the scheme and the company are threatened by the risks of an increased deficit, in spite of it only being a small scheme. So, how can pension schemes go about implementing an IRM strategy? The Pensions Regulator's suggested approach is shown on this slide, and the first step is to assess the key risks facing the pension scheme. So having identified each of the key risks, some work is then required to understand the probability of the risks crystallising and the likely magnitude of those risks. Once that's done, the overall exposure to risks can be understood and compared against the capacity and appetite of the scheme and its employer to cope with those risks should they materialise. This can then be used to inform the pension scheme strategy in areas such as funding, investment, and also future de-risking strategies.
Okay, so before we get into the details of each of those individual steps, we'll just quickly now revisit the two live polls that we ran earlier, and thank you all for taking part in those. So in the first poll, you'll recall that we asked the question, do you think there is value in pension schemes answering the questions posed by IRM? And I'm glad to say that no one thought that there was no value in answering those questions. Around 2/3 of respondents said yes, they thought there was value in answering the questions, and the majority of the remainder said that possibly there could be value in answering those questions. So I think that's positive and hopefully means that the regulator introducing this has gone down quite well. In the second poll, we asked if you were involved in a defined benefit pension scheme, whether your scheme had already put in place an IRM strategy. And interestingly here, there was a much broader spread of answers. Around anywhere between 20 and 25% of people ticked on any one of the answers. So around a quarter of respondents said they hadn't yet put in place an IRM strategy. Around a quarter said that it's currently underway. Another quarter approximately said that they had, yes, put in place an IRM strategy. And the remaining approximately quarter of people were not sure.
So, back to the process of implementing IRM. As previously discussed, the first step is to identify the key risks, including both their impact and the probability of them occurring. Now, in a pension scheme, covenant, investment, and funding risks are all closely related. The covenant of the sponsoring employer allows the trustees of the pension scheme to carry investment risk, with the view of providing asset returns, but only to the extent that this risk can be supported. So in essence, a riskier investment strategy may be appropriate where all parties are comfortable that should the anticipated returns not materialise, the company will be able to support any losses, particularly if that involves increasing contributions. The resulting investment strategy and the level of risk directly impacts on the scheme's funding strategy, both in terms of the assumptions adopted for the purposes of the valuation and also when it comes to putting in place a recovery plan. So the current asset allocation and anticipated future changes will determine the valuation discount rates and also the asset growth assumed in the recovery plan. Now, both the valuation assumptions and the recovery plan are also directly impacted by employer covenant. So, for example, in terms of the amount of prudence required and the appropriate length of the recovery plan. The trustee and company must agree how much asset return to budget for, depending on the extent to which the trustees and company are comfortable taking credit for future investment performance. And then, of course, the details of the recovery plan can impact on the covenant of the sponsoring employer, particularly if the cash contributions agreed are material to the business or impact on its long-term sustainability. So really, due to the key nature of employer covenant in all of this, the regulator has stated that the best place to start with IRM is the employer covenant. And this makes sense. So in order for trustees and companies to know how much risk they're comfortable taking, they should, first of all, understand what support there is for these risks, should the downside scenarios occur. And indeed, for any of you who have had experience of a conference call or a meeting with the regulator, you will recognise this approach. Even if the regulator's concerns appear to be focused on the level of prudence within valuation assumptions, or the level of recovery plan contributions, or the investment strategy, they will always begin by discussing with the trustees their view on covenant, because in essence this has formed those concerns. In other words, they have formed a view on risks relative to covenant rather than risks in isolation. Now, Alex Hutton-Mills is going to talk us through how to go about assessing the employer covenant.
Thanks, Victoria. So I suppose the overarching theme that you should probably take away is that a covenant assessment is an exercise in relativity. And by that I mean the relative size of the scheme to the size of the sponsor, but also the fact that without a scheme there isn't really a covenant. I mean, we often hear sponsors talking about trading improvements and financial improvements of the sponsors supporting the pension schemes, but not necessarily recognizing what's happened to funding and or the investments over a period of time. So in order to understand fully and in an integrated way the covenant and how that covenant can change over time, you do have to recognize and understand the size of the scheme, the sponsor sector within which it operates, and also the legal obligations and who actually has the obligations to the scheme to meet that funding over a period of time. So I think, as Victoria's pointed out, starting with the covenant helps with the logic, and the covenant really is broken into two sections. There's the legal obligations, and then there's the financial ability to meet those obligations over time. So you start off by having clarity of understanding which entities are legally required to support the scheme, and that's starting both through the trustee rules, so understanding is the scheme a last man standing scheme, or do each of the individual employers have allocated liabilities on a different basis. Are there other contractual and legally enforceable ways that the scheme has access to the broader group? So the entities that are legally responsible are your so-called direct covenant, but it may be the case, and it's usually the case, that schemes are sponsored by entities within a broader group. So the question then is the extent to which you have access to that broader group through legally enforceable arrangements. And I think the regulator's been quite clear in moving away from the concept of willingness to looking at legally enforceable, codified willingness, and recognizing that willingness in how it thinks about covenant strength. Then there's the question of how robust that legal relationship is, which is partly a question of the strength of the terms, so whether that's through parental company guarantees or other commercial agreements that underpin the revenues and the profitability of the entities that are sponsoring the pension scheme. So that's the legal obligation. If you're looking at the financial ability, it's both looking historically at the position in order to understand and get a sense of trends, and that is really looking at historical financial information, so profitability measures, liquidity measures for both the employers and any wider group, and then assessing the extent to which those entities on a historical basis have been able to support the funding of the scheme on an ongoing basis, and also to the extent relevant in distress scenarios. I think that the critical change between the first version of the Code of Practice that came out when the legislation was first put in place and the recent version that was reissued in 2014 is the greater emphasis that's being provided to prospects. I think it goes without saying, if you look at the duration of the potential liabilities of the scheme and you think about the financial information that you have, it's pretty important that you have a view over the hill, and therefore understanding the prospects of your sponsors and the wider group and the relative prospects of those entities, depending on which sector they operate within, are very important as it goes to understanding the strength of the covenant. So what are the sort of components that go into assessing those key covenant risks? I think the key point really is that it's a balance between both quantitative and qualitative metrics. If you look to the left-hand side of the slide, the quantitative factors are things like profitability, liquidity, leverage, by that we mean debt leverage, and recognizing the funding risks in terms of the ability of of the sponsor, both from a profitability or liquidity perspective, but also in terms of the assets on the balance sheet that are potentially able to be liquidated and to be sources of value to cover those pensions obligations. And the plan funding itself, as I said, this is a measure and an exercise in relativity. So unless you understand the extent of that funding risk on an appropriate basis, so not just on an accounting basis, but both on a technical provisions, but also on a solvency basis, because that is the full extent of the risk, that starts to help you move towards a broader view on how strong that covenant is to support the funding risk over the life of the scheme. That data tends to be available in the public in terms of historical financial information, but where there tends to be sticking points is around forecasts. And I think as employers have better understood that a covenant assessment is not intended to be an audit and it isn't an audit, but also the fact that the more transparency there is in terms of information that's shared with the sponsors, the better the answer that you get, which means that trustees are less likely then to build prudence out of a lack of knowing into the technical provision assumptions. It's important that companies are comfortable and willing to share those forecasts, and clearly there are non-disclosure arrangements and other mechanisms that you can use to ensure that the information isn't misused in any sort of way. But it's important to have that view over the hill, and it's that those forecasts typically have to come from management, so there needs to be some collaboration between the management teams that are providing the information and the sponsors and their advisors who are assessing this information. And actually that tends to be, from a proportionality perspective, more of a challenge for smaller schemes where those forecasts are not necessarily as granular or haven't been made available in prior valuation exercises. Access to management is also important for the qualitative factors that we've set out on the right, partly because it helps you understand and get a better feel for the strategy that the management team has in place, how they're recognizing and responding to market changes and the sector within which they operate. If you're in, for example, financial services, there can be regulatory change. So again, understanding how the management team intends to respond to regulatory change is important, and also understanding their perspective on market risks, both to the sponsor but also to the scheme, and their understanding of the scheme are all important aspects on a qualitative basis that help derive an answer in terms of covenant strength. If you put those two together, that then gets you an answer in terms of your covenant strength, which allows you to think about the risk associated with the scheme.
Okay, thanks, Alex. Before we then go on to talk about investment and funding risks, we'll just turn to our third and final poll for the day. And this poll works in exactly the same way as the previous two polls. And again, please only answer this question if you're involved in some way with a defined benefit pension scheme. So we'll answer this poll as soon as we can, but just to read out the question this time is, how would you describe the nature of the covenant work undertaken for your scheme? Possible answers here are A, it's undertaken by an external specialist and detailed work is undertaken. B, it's undertaken by an external specialist but only high-level work is undertaken. C, the company provides information to the trustees which then informs their view. D, the trustees form their own view on the covenant. E, something else is undertaken, and then F, no covenant analysis is undertaken. So we'll open this poll very shortly, and again you'll be able to answer it using the box that should now have appeared on the right-hand side of your screen. And we'll give you, again, 45 seconds to select one of the answers and then input it. And again, all answers to this will be treated anonymously, but we'll share a summary of the responses later on in this session. So that's been 25 seconds so far. I'll give you 20 seconds more just to finish answering that poll. And just to repeat the question, how would you describe the nature of the covenant work undertaken for your pension scheme? Okay, just 5 seconds left for that poll. Okay, thank you for that. We'll close the poll shortly, and whilst I analyse the results of it, I'll pass back to Victoria to look at not just the covenant risk, but now the funding and investment risks.
Okay, so we've looked at how you might go about assessing covenant risks, and as Paul said, we'll now look at funding and investment risks. As a reminder, the regulator's guidance says that schemes should identify what the material risks are, in what scenarios do these risks arise, how do those scenarios arise, and how likely are those scenarios to arise. Now, thankfully, most of these questions should already have been answered when the trustees last worked on their risk registers. And so perhaps the best place to start is to revisit the existing funding and investment registers and ensure they are complete and that they include up-to-date assessments that include both the magnitude and the probability for each risk. Appreciating that this is potentially quite complex, perhaps the simplest way of quantifying each of the funding and investment risks posed is to start by reviewing the dashboard of our valuation system, which displays key risk metrics. You can see at the bottom right-hand corner that the Model Solutions dashboard shows the impact on the scheme's financial position of key scenarios such as interest rates changing, inflation changing, equity prices falling, and mortality being different to that assumed. Now, other funding and investment risks can also be extracted from the system through scenario testing. Now, Alex will talk us through how we can take all that information about all the different risks and bring it together into an integrated approach to risk management.
Thanks, Victoria. And I suppose the overarching theme really is that it's not just, it starts with looking at the risks individually, but actually you need to put them together. And the easiest way of doing that is by first looking at, I suppose, the bilateral risks, so understanding the covenant and funding, and then understanding the covenant and the investment risks, and then finally looking at how the investment and funding risks operate, and then moving on from that to consider how all the risks interrelate, recognizing and trying to identify where you have high concentrations, material impacts, so that you start to put together a map of your overall risk exposures, so you can therefore identify which you consider to be the material risks or those risks that have a material impact. Now, on this slide, this just helps shape how we use our 9-point scale to help inform and think about the covenant and other risks. We have 9 points ranging from very weak to very strong, and essentially the question of how the covenant informs your investment strategies is really a function of how much risk the covenant can tolerate, because ultimately the covenant is the aspect that underwrites that risk going forward. So to the extent that you have a very weak covenant, the idea being that you should then have an investment strategy or a hedging strategy that is more like solvency, so you should have more or mostly matching assets to minimize the potential volatility that you have, recognizing that that has an impact on the size of the deficit, and therefore there's a greater weight that's being placed on the covenant strength. On the other hand, the stronger the covenant, the more risk you can potentially tolerate and the more risk you can potentially take. I would think of these as maxima, to the extent that it may not be the case that you want to take a lot of risk, but it ultimately sets the outward bound of the risk that you can take, and then you have choices in that framework in order, in respect of how much risk you actually want to take. Your investment strategy then has an impact on your funding assumptions, and you need to think about your funding assumption and what that means in terms of the technical provisions and the other valuation bases and how much strain that puts on the covenant going forwards. And again, ultimately, if you're a very weak covenant, you should be more prudent and building more prudence into your funding assumptions. And if you're stronger, you can potentially be more towards a best estimate type approach, recognizing that ultimately you are looking to fund the scheme over time. But the interrelation between your investment strategy and the risk you can take and the prudence that you're building in for the technical provisions, which is today's funding position, means that you can take a longer term view on how you're ultimately going to fund the scheme over time. The final piece is you obviously either fund and meet funding obligations through cash or investment returns, and your recovery plan gets you to the answer on a technical provisions basis. So the strength of your covenant and the risks associated with that covenant should inform the length and the shape of your recovery plan and the investment returns that you're potentially comfortable tolerating in view of the investment strategy that you're adopting. How do you look at these risks when they are pulled all together? I suppose the strapline is a good place to start, and I think one of the developments in the market is for advisors, just on a very practical level, to be working together. One of the things that has happened more frequently and is a useful exercise is actually having the advisors, the scheme, and if possible the employer putting a workshop together, which actually is probably the most efficient way of doing this, where you can do some scenario testing and scenario planning to identify the risks and how those relevant risks interrelate, so that both the employer and the scheme have a better understanding of the total risk exposure, and you can therefore develop a plan that's integrated both in terms of the trustee side and with your sponsor as to how to manage those risks over time. So if you start down at the bottom thinking about how the covenant risks impact the funding and investment strategies, there's then the question of how do you identify and develop and consider any causal links or interdependencies that there may be, and that's really a function of the asset allocation, the benefit structure that you might have, for example, in terms of the inflation linkages in your benefit structure, but the other important aspect is the market sector that the covenant operates within. Having identified the relevant risks, having understood and identified some of the interdependencies, you then have to question whether or not there are common themes. So it may be that you've identified a number of market risks or economic risks that impact both the sponsor and the scheme on the asset and or the liability side. And then there's the question of other external shocks. So again, we come back to the oil price movements that have happened of late. They may be a systemic risk, or if you're in the financial services sector, the sort of systemic risk that we had when the financial crisis happened back in 2008. So having identified and understood the risks, you can then understand and start to navigate towards an answer of, well, are there concentration of risks that might prejudice the ability to meet the funding objective over time. So what does this mean in practice? And we thought that we would set out a simple example to help identify this. If you imagine that you have an oil services company as your sponsor, you have a relatively large scheme of about $3 billion that's primarily invested in equities. If you look to the left-hand side of the screen, you'll see that its equity balance is 75% equities and 25% corporate bonds of a good investment-grade quality. Within that equity bias, within the equity allocation, there's a strong bias towards resource stocks, which essentially means that the equity performance is linked to sponsor risk. Now, what that means is, if you were to think of the current environment where you've had either an oil price shock or we've potentially got a sustained low oil price environment, there's the risk of a double whammy of your sponsor weakening at the same time as the scheme funding on the asset side has had an adverse impact. And it's likely to be the case that any inflation benefit from your benefits on the liability side is outweighed by the adverse impact on your asset allocation. And if you look at the funding at the time, so you have a technical provisions deficit of 150 million, a solvency deficit of $750 million, and a self-sufficiency or covenant agnostic deficit of 450 million, with a relatively modest free cash flow of 15 million per annum, a sizable asset base, but a meaningful amount of debt. And essentially, the question as articulated in the middle is everything in balance. And it may be the answer here is that there's a risk concentration and you actually need to try and readjust the concentration, both in terms of the asset allocations, but also in terms of the choice of those assets in order to try and mitigate the risk of that commodity price impact. So going back to the flow diagram that Victoria had articulated earlier, once you've assessed the risks individually, looked at them on an interdependent basis, you then start to have an answer as to understanding how much risk capacity you can absorb within the scheme given the covenant. And then the next thing to do is identify how much risk appetite you have and compare that risk appetite to the capacity. And to the extent that that risk appetite is above and beyond the risk capacity, it may be that you need to reallocate and readjust your risk capacity to respond appropriately. Having assessed the risk, your risk capacity, risk appetite, then the next thing to do is to consider how you can manage the risk. And again, the regulator isn't saying don't take risk. What they are saying is understand the risks that you can take and manage those risks so that you have plans available should those events occur. That comes onto the contingency planning, which I think is actually the most difficult aspect of the regulator's guidance. So they have talked about contingency planning in various guises in the various forms of guidance. And where this is now developing is it's really saying understand and have contingencies in place, and to the extent that it's proportionate to do so, document how you would respond in the event that your material risks materialize. Essentially all that does is it means that you can govern the scheme better because you can manage and understand with the sponsor's buy-in your management playbook to the extent that the risks that you're concerned about will crystallize. Final piece is documenting, and I think this is the bit that will probably take some time to develop in the market, and it'll be a function of resources available to trustees, resources available and time available to management teams and also pension scheme trustees. If you have had the opportunity to assess, identify, and consider management of those risks, then clearly, ideally, it would be good to document those risks in some shape or form. The challenge may be that you have all the relevant aspects in various places, but it's not necessarily pulled together in a coherent way. So I suppose best practice is really document these things in a single place in order to facilitate governance of the scheme. But I think the key bit is to make sure that there's a way of identifying and having gone through the exercise to document how you would respond in the particular circumstances. And having put through all the effort of documenting, then I think again, as Victoria has touched on, the next thing to do is to monitor that over a period of time to avoid just coming back to our quote from the enterprise risk management document, crisis management. So having documented, understood and monitored over a period of time, hopefully that should avoid crisis management given the opportunity cost, the potential embarrassment of crisis management as an unforeseen event.
Okay, thanks Alex. So that now brings us on to the results of our third poll. And this poll, which was for those of you involved in a defined benefit pension scheme, was how would you describe the nature of the covenant work undertaken for your scheme? And there were 6 possible answers. The first 2 were that it was undertaken by an external specialist, but with different varying levels of detail undertaken, and then ranging from that to the company providing information to the trustees for them to form a view, the trustees forming their own view, other or no covenant work undertaken. I'm glad to say that no one said that no covenant work was undertaken for their pension schemes, and of the rest of you, the vast majority said that your covenant work was undertaken by an external specialist. Around 2/3 of you said that an external specialist was involved, with around 60% of that 2/3 saying that detailed work was undertaken by an external specialist. The remaining sort of 1/3 of the 60% said that high-level work was undertaken. Of the remainder, very few people said that some other form of covenant work was undertaken. The vast majority had covenant work undertaken as described on this slide. So the next favourite choice was that the company provides information to the trustees, and then the least frequently answered option was that the trustees form their own view of the covenant. Okay, so that concludes today's presentation, and we have had a number of questions come in as we've gone through. Unfortunately, we won't have time to address all of them now, but I will take a couple of them that relate directly to covenant, and so I'll address these two questions to Alex. So the first one is, what do we see as a minimum response to the new IRM code from a covenant perspective?
Yeah, and I suppose there's two different ways to think about that. For the covenant assessments themselves, I think at a minimum, and to try and make sure that the advice is integrated, what we're certainly aiming to do is consider the ability of the covenant to support the risk, which can be measured by value at risk or by some other measure, or we look at some deterministic scenarios and try and give a sense of what impact that may have on the sponsor, so that people at least have a sense of the consistency of approach in terms of the value at risk that your investment consultants are looking at and how that then applies to the sponsor in that same stress scenario. I suppose for advisory teams, at a minimum, and again I think this is a healthy development in the market, the advisors should get together to consider the covenants, the investments and the funding risks, to make sure that their advice overlaps and dovetails with each other appropriately.
Right, and then the second question that relates directly to covenant, which again I'll address to Alex, is do we have any examples of successful integrated risk management in practice?
Yes, we do. I mean, we have a large oil production company as a client, and one of the things that we undertook with them was one of these workshops where it was the trustee executive with advisors considering various scenarios and the impact of those scenarios. So we were looking at a sustained low oil price environment. We were looking at oil price shocks and the impact that had on investment decisions within the sponsor, and also material corporate events and the potential impact that had. And having worked through those scenarios, we then developed a contingency plan, which the trustees are using as part of their broader integrated risk monitoring framework.
Great. Okay. I think, unfortunately, that's all the time we have for questions. There have been a few others that have come through, so we will take those away and put together a Q&A document, which we will place on our website shortly after today's session. So that brings this webinar to a close. A recording of this webinar will be available on the website within the next few days, and we'll send you an email as and when that's available, and in that email we will also include a copy of the Q&A document that I just described. Now, if you'd like to discuss any of the topics covered today in any more detail, please don't hesitate to contact either your usual Xafinity consultant, or you can contact either Alex, Victoria, or myself, and we'd be delighted to help you. So thank you all very much for joining. I hope it's been a good use of your time. And I'd be grateful if you would just spend a few seconds as you leave to complete the exit feedback questionnaire. Thank you very much and have a good day.